Joel Greenblatt's hedge fund was open to the public for 10 years. Its average annual return was over 50%. In his brilliant book, You Can Be a Stock Market Genius, he reveals where he found and how he selected the stocks that allowed him to be so consistently successful. Two of his strategies are particularly interesting and super easy to understand and implement. And I can't wait for you to get started. Hey, thanks for being here. I hope you love this stuff as much as I do, because there are some amazing opportunities out there like these to build your rapidly growing, highly diversified net worth. And one video at a time, that's what I'm sharing with you here on this channel. Greenblatt, in his book, dives into mergers, rights offerings, restructurings, and several other very specific occurrences in the world of business and stocks that create amazing opportunities for the disciplined, research-focused investor. And if that sounds like something you're interested in, and since you're here watching this video, I can only assume, then you should probably get yourself a copy. I've linked out to it below in the description. You won't be disappointed. And these opportunities that he talks about in his book and that I'm going to talk about in this video aren't going away anytime soon. And you'll see what I mean as we dive in. My two favorites from the book are spinoffs and bankruptcies. Let's start with spinoffs. Sometimes a business grows large and diversified enough that it makes sense to split up. This could be because the business made some bad investments and wants to offload them. It could also be because part of the company is so different from the principal line of business that both parts would just be better off on their own. There are a lot of reasons that this might happen. Some examples are when Philip Morris was spun off of Altria in 2008, Chipotle was spun off of McDonald's in 2013, PayPal of eBay in 2015. What started as a small part of a much larger company had grown to the point that it couldn't thrive quite as well unless it was allowed to go off on its own.
You've got to go. Go!
Well, when something like this happens, there is some inevitable and understandable confusion in the investment world. If the spun-off entity is small enough, there is often indiscriminate selling from large holders of the stock. This can cause the price per share to plummet, which causes other investors who were on the fence about this newly formed entity to also jump ship, further perpetuating the problem. So the share price just keeps going down. And there are several reasons why this happens. And those reasons, like I said before, they aren't going away. Think about it from the perspective of the manager of a large mutual or pension fund. You and your team invested in the original company after much research and due diligence. You have your specific calculated reasons for investing in the larger, the parent company. But the new spin-off was just a small part of that larger original company. It may not have even come up in your original research. And as a disciplined fund manager, that doesn't fit into your calculated approach. So you just sell. Or what if your fund specializes in a specific industry and the newly formed entity is actually in a very different industry than the parent company? Like if a car company spins off its credit arm into a new independent financial firm, it doesn't make sense at all for you to hold on. So of course you just sell. Or what if your fund has rules, as many large funds do, about the size of the companies in which you can invest? By your own rules, you may not be allowed to continue to hold the small spun-off company. So you just sell. You have to there. Regardless of the fundamentals, you don't care. It often doesn't matter. You just sell. And we're talking about large funds here. So as these many large funds with their large share count exit, this pressure drives prices down a lot, creating opportunities for you and me. Greenblatt cites a relatively old statistic, which is still interesting to consider. He says, one study completed at Penn State covering a 25-year period ending in 1988, found that stocks of spin-off companies outperformed their industry peers and the Standard & Poor's 500 by about 10% per year in the first 3 years of independence. Now, of course, this just happened in history, which doesn't predict what will happen in the future, but it gives you some useful perspective on the potential found within this relatively small pool of stocks. To be clear, I definitely don't recommend you just buy up every single spin-off company without further consideration. As always, due diligence, analytical research are still recommended and probably required for long-term success. But this understanding of spinoffs and how they work in the market provides a compelling starting point for your undervalued stock discovery process. Now let's talk about bankruptcies. Imagine you're researching a company that appears cheap. You're trying to figure out why, and then you find it. It recently went through a bankruptcy within the last few years. How does that make you feel? For most, that's the end of their research. They have no interest in dealing with a company with such a checkered past. But this is a perfect example of the type of opportunity Warren Buffett was referring to when he said, "Be fearful when others are greedy, and greedy when others are fearful." Again, of course, I'm not suggesting that you just buy up every company with a past bankruptcy. But if your detailed analysis suggests that the company is undervalued based on its merits and prospects today, it may be other people's fear suppressing the price. That fear can be the disciplined investors, our opportunity. Greenblatt mentions 4 reasons a restructured yet solid company might see depressed valuations. Again, indiscriminate selling, this time from banks, bondholders, and previous creditors. He says, there is ample reason to believe that the new holders of common stock are not interested in being long-term shareholders. Due to an unfortunate set of circumstances, these former creditors got stuck with an unwanted investment. Consequently, it makes sense that they would be anxious and willing sellers. Next, you have what are called vulture investors. They will occasionally invest in a bankrupt company. They're looking for a surge in share price after the restructuring is complete, which often happens. And then they leave, pushing the price back down. Then think about Wall Street. Analysts there don't get paid to sell post-bankruptcy stocks like they do with IPOs. Greenblatt says, between the ephemeral shareholder base and the lack of Wall Street attention, it may take quite a while for the price of a stock issued through the bankruptcy process to accurately reflect a company's prospects. Finally, a low market value stock may take time to attract the attention of big market players, as they likely could not take a big enough position to justify the research time and expense. In fact, in this video, we discussed the opportunity that this fact alone creates for you and me across all low market value stocks, the small cap stocks, the micro cap stocks. In this case, Greenblatt reiterates, these situations are truly orphaned and may trade cheaply for some time before they're discovered. I actually chronicled my first experience with the stock of a previously bankrupt company. I did it in an article that I wrote for Seeking Alpha. I'll link to it below so you can check it out. It was published on August 10th, 2016, when the shares were trading around $4.30. I presented this very case. I was able to identify the indiscriminate selling that was taking place by the 6 banks who were left with roughly 7% of the shares outstanding. That's a lot. Think about that pressure. They hadn't been allowed to sell their shares until earlier that year, earlier in 2016. And that's several years after the company had emerged from bankruptcy. Obviously, they didn't really want to be there. The bankruptcy courts had just forced them to be there. That was just the settlement. Think about the downward pressure with that massive sell-off looming. The company's fundamentals were still sound, despite its low share price. So my thesis was that one of the main reasons for this suppressed price was the banks. I suspected that through abnormally large trading volume, you'd be able to see when these banks were exiting their positions, thus removing that pressure and creating an amazing opportunity for research-based investors. And that's exactly what happened. Today, as of this recording, a year and a half later, it trades around $15 per share. When you can understand what's going on behind the scenes, specifically the psychology driving the other market players, you'll begin to see these opportunities. And I'm not saying they're common. I'm not saying that you or I will be right every time. I'm saying they exist and will continue to exist. And the first step of being able to identify them is an intimate understanding of those occurrences so that you know what you should be watching for. And a great way, probably the best way for you to do that, where I first began developing my understanding of special situations like these, is through Greenblatt's book directly. Again, I'll link to it in the description. If these strategies interest you, I highly recommend it. The other way you could learn more about these strategies is for me to continue making videos about them. What do you think? This video is a little bit different than the other ones I've done. Would you like me to dive deeper into either of these two strategies? Or would you like to be introduced to some others? I want this channel to be as helpful for you as possible. So be sure and let me know in the comments. I will be there, I will read everyone, I will probably respond to everyone if it makes sense. I want to know because I want to create those resources for you. If you can get to where you're successfully implementing these strategies, that's one of the ways. It's not the only way. You don't have to do this, and you really shouldn't pursue them unless you are actually interested in them. But if you can get to where you are, that's one of the ways that you can build your rapidly growing, highly diversified net worth. So if you'd like to continue on that path, don't forget to subscribe and click the bell. Leave me a like if this was helpful. I can't wait to see you in the comments and in another video. Take care.